Welcome to this presentation in which we're going to cover Chapter 15. This is the chapter in our textbook that covers insurance, and this is, of course, the final chapter that we have in our textbook. So let's go ahead and begin. We've got several topics here in this chapter. The first is kind of an overview about how insurance works generally. Then we're going to discuss a few categories of insurance. We're going to talk about how you ought to go about selecting an insurance carrier, and also how you might want to select a particular insurance policy. And finally, we'll consider some policy issues. So let's begin. So as we're again doing the general introduction to insurance law, we're going to explore three issues. One is coverage, another is exclusions, and finally we're going to talk about ability to pay. So let's first of all define some terms. The term to insure means to protect from risk. When we're talking about life insurance or an insurance product, we're going to spell it I-N-S-U-R-E. There's another word in English which we pronounce in a similar way, depending upon our accent, I suppose, and it has a somewhat similar meaning, but it doesn't have to do with insurance products. So this word is kind of similar. This word we might use if we're saying he ensured that the door was locked. That means he checks it again to make sure, yeah, it really is locked. That has somewhat different meaning, and again, it doesn't relate to insurance products. So these aren't interchangeable for our context. So what is insurance? Insurance is a method of spreading risk. The world is a scary place. Bad things happen to people all the time, and insurance doesn't solve that problem. It doesn't make the bad things go away, but it helps us all kind of carry our little piece of it. You may be familiar with the expression, many hands make light work. Well, that's the idea here. The more people who are bearing the risk, the less any one person is kind of overwhelmed by the risk. Imagine for a second that you are a completely, or you have the intellectual powers of an adult, and you are a newborn baby, and you have no information about your genetic legacy. You don't know whether you're likely to get a bad disease as a child or as a young person, or whether you'll live to be 100 with relatively few health issues. You are told at that point, listen, you can bear all of your risks all on your own, or you can choose to, if you happen to have or whether or not you have a bad event, you can purchase this insurance, and it can't save you from whatever your genetic history might provide, but it does mean that you will have this coverage in the event that you develop cancer or something like that, so you won't have to pay the costs out of pocket. Well, most of us, not knowing whether we're likely to develop those diseases or not, would say, yeah, I like the idea of spreading that risk. If I happen to be the lucky person who doesn't develop the bad disease, yes, I will have spent more money than I needed to. I would have insured myself against things that didn't end up actually happening. But after all, that's generally good news for me that I'm healthy, and so I'm willing to take that slight reduction in income in exchange for the good health that I'm enjoying. On the other hand, if I happen to be one of the unlucky people who gets the diseases early on, it certainly would be easier for me if I had that insurance product that allows me to only pay a portion of the cost. And that's where most of us come down. Most of us are pretty risk averse. Businesses also happen to be risk averse, and as a result, businesses oftentimes decide, quite reasonably, that insurance is a good financial decision for it to make, and so it's going to buy for that reason. But it also has other reasons to buy. Sometimes it is required by law to buy insurance, or if it's borrowing money, its lenders might say a condition of this loan is that you have insurance. So there can be lots of different reasons why a business might buy insurance, but virtually all businesses really of any size or that are not huge are going to have insurance. And again, there's lots of different types of insurance, but one or more combination of insurance products. Let's consider the term actuary. An actuary is a human being. This is a mathematician who computes the statistics to come up with what are the risks, and that person also establishes the premium rates. It crunches the numbers to see how many people in this particular state died from this particular disease, what's the average life expectancy, and then it takes that data and figures out what the premiums ought to be for somebody with this particular life circumstances. And so this is the term actuary, and we call the science the actuarial science. And so this is the term that we have, actuary. This is an area that involves a lot of pretty sophisticated mathematics to become a true actuary. Becoming a true actuary is kind of like becoming a CPA. It's something you need to take a lot of tests and a lot of education. So many people who function in the actuarial function don't have all of the credentials. Maybe they're moving toward the credentials, or maybe they are working for an actuary, helping that actuary crunch the numbers. So let's consider, if we were actuaries, what we would expect to see from an insurance company, or what we would tell the insurance company they ought to have before they decide to offer a particular insurance product. Well, one thing they want, the actuary would want the insurance company to have, is they'd want the insurance company to be facing a hazard that many people face. So it can't be something that only a very small portion of the population is concerned about. A significant number of people have to be thinking, wow, I'm going to want to buy insurance about that. Because again, as I said before, many hands make light work. If you don't have many hands, then there isn't that group of people to spread the risk over. And so you need lots of hands to spread the risk. The next thing we need is we need some way to measure the loss or the cost of this particular idea. If somebody becomes ill with cancer, we can calculate that because we know the types of treatments that might be a factor in the cancer diagnosis. If a person dies, the person hasn't bought an insurance product with a certain value associated with it, and that's what will be paid out. But if you were to try to insure something like a person's reputation. Well, how do you decide what a person's reputation is like? Every now and again, you'll see kind of fluff articles that say Lloyd's of London has insured this or that thing. They're kind of funny type of ideas. They really don't reflect a genuine insurance product in the way that we're talking about genuine insurance products. So they need to have something that you can pretty easily crunch the numbers and come up with a value or a cost associated with that. Needs to be measurable, reducible to dollars and cents. The next thing is you need to have premiums that people are going to want to buy. Again, you need to have a lot of potential customers to market to, and then you need to have a fair number of customers that are going to say yes to your product, because again, if they're just potential customers, they don't become real customers, then you're not spreading the risk. And finally, you don't want to have such a risk that could happen that it could bankrupt the company. So let's say there's an event that happens rarely, but when it happens, everyone is, or a very large portion of the population is going to be affected. So you're going to go from having maybe very few claims to suddenly having a huge number of claims. Under those circumstances, you're not going to be able to pay out, you're going to go bankrupt. You want to have, ideally, a system in which you're going to have a pretty steady flow of just a few claims every year or so. So those are some things that you look for when you're trying to plan out what would be a good market to enter for insurance. So what is an insurer? Well, again, it's some entity that provides that insurance product. The three big categories of insurance are going to be life, health, and property casualty. Life and health are pretty self-explanatory. When you insure a life, it means that there's going to be a payout when that person actually passes away. Health insurance is insurance designed to maintain the health of that person. So if I get diagnosed with a disease or I'm injured or something like that, then this benefit, this insurance will help me regain my health, will treat the symptoms, will assist me in regaining my good health. Property and casualty we'll talk about on the next slide. So property insurance provides protection for things like floods, fires, lawsuits, automobile accidents. The property that gets injured as a result of those events. And you can see some are man-made, like a car accident or lawsuit, and some are natural. Whatever kind of insurance a particular entity is seeking, the thing that the insured is going to pay, we call a premium. And this is the payment. Usually it's on a monthly basis, but it doesn't have to be. It can be on an annual basis or quarterly basis, or it could even be a one-time payment. Anyway, this is the price that is associated with the insurance coverage. Going back to my example of many hands make light work, the many hands are all paying premiums into the insurance, all hoping that they never ever have to file a claim, that they remain healthy, that they remain alive, all that good stuff, that they never have a significant property loss. So who's the insured? Well, this is the person who's purchased the policy, who's trying to reduce that risk. So going back to the example of our three categories, the insured is the person whose life is being insured, the person who's going to die. Now, in this situation, the insured isn't ever going to see the proceeds of the insurance policy. He or she's going to be dead. It will be the beneficiary that that person has selected. In the case of health insurance or dental insurance, for example, the insured is the person who, if he or she becomes sick or injured, he or she is going to have that coverage to get medical assistance. And then for property casualty, the insured is the person who owns the property or casualty that is being insured. In order to be eligible to purchase insurance, the buyer or the insured has to have what's called an insurable interest. This is a legal term, and typically to have an insurable interest, you have to have either an ownership interest in the item, or you have to have some right of possession associated with the item. And most commonly, you're going to have ownership interest. So I'm not likely to be permitted to insure something. For example, let's say my next door neighbor buys a fancy car. I'm not going to be able to buy insurance on that car because I don't own it and I don't even have the right to possess it. So under those circumstances, I don't have an insurable interest. So even if I attempt to buy the insurance, the company's going to say, wait a second, you don't own this and you don't even have a lease for this item. So we're not going to allow you to insure that interest because you don't have an interest. The document that creates the responsibilities, both to pay the premium and to pay out claims, we call a policy. A policy really is just it's just a contract. It's a contract between the insurance company, who's the insurer, and the person who's going to benefit if a claim is filed. Again, we're going to accept the life insurance situation from this. Generally speaking, the rules of ordinary contract law apply to insurance policies. There are a few statutes that exist in this area that somewhat affect how the policies are interpreted, that may vary a little bit from contract law, but for the most part, it's just a type of contract. Let's talk for a second about life insurance. One of the things that can happen with life insurance is that obviously if a person dies, whenever that moment comes, then the policy will be paid out to the beneficiary. But sometimes the policies will provide that at some point, we'll say right here, we'll say at age 90, the insured hasn't died. And so at that point, the insurance company might say, well, you know what? Our actuarial tables say very few people are going to live past 90. And so what we're going to do, and this would be part of the policy, of course, is we're going to, instead of not paying out on the policy, we're going to pay you an annuity, the value of your policy, but we're going to pay it to you in your lifetime, starting at, in this case, 90. And so every year, you're going to get a payment of a lump sum. And let's say you ultimately die. Let's see, we'll go a few more years. You're hanging on there, doing great, or doing at least okay. So we're 91, 92, 93, 94, 95, 96, 97. You die on your 97th birthday. So now there are some payments perhaps that have not been paid. So your beneficiary at that time would get any remaining balance with respect to the annuity. And the annuity will continue to pay out as long as you're alive. So let's say you don't die at 97, you end up dying at 120. Well, of course, the payments are going to be significantly more than perhaps what would have been paid out in a lump sum if you had died on your 90th birthday. On the other hand, perhaps you could have died the day after your 90th birthday and your annuity has not given you that much more money. An annuity, as you can see by the name, is paid out annually or yearly typically. It doesn't have to be, but that's the common strategy. So this is yet another way of paying out the benefits on a life insurance policy. This isn't an option in all life insurance policies, but it is something that certainly pops up from time to time. Annuities exist under other circumstances as well. This is just one particular method of doing this. And the idea behind an annuity is that when people are planning for the retirement years, obviously they don't know how long they're going to live. And so the idea is, well, I want to plan so that I have enough money no matter how long I live, but if I am too conservative, if I say, well, gosh, I might live to 120, and I end up dying, say, at 66, I will have been much more conservative with my money than I needed to be. I should have been able to go on more cruises. I should have been able to drink more champagne and eat more caviar. If I had only known that I would not need all of that money, then I might have made other choices. Well, an annuity helps you manage that because it's not going to pay out until kind of your expected death date, probably even a little bit beyond your expected death date. So what you can do is you can say, well, you know what, I'm going to plan, I'm going to save my money and spread it out so that I can get to at least 90. And then if I'm still kicking at that point, then I'm going to have this annuity tied to my life insurance policy, and I can use that to keep me fed and provided for until the day that I actually ultimately expire. So it can be a way of spreading that out. And people use annuities outside of life insurance policies. I could, when I turn 65 and retire, I could take all of my investments and just purchase an annuity, and that will pay me out. And there's lots of different annuity products, but you can have one that's going to pay out, every year for the rest of my life, whether I live to be 66 or live to be 166. And the amount won't vary because it will have been actuarially calculated to reflect, my likely death date. Obviously, some people will die before the date, some people will die after that date. It's designed to reflect that overall risk. Let's talk about the concept of indemnification. I think I've already shown this word before. Here we go. We talked about it with property casualty insurance. This is about protection for the loss of something. That's what indemnification is. Indemnification comes up several different ways in the law, but the definition we're going to focus on here is to indemnify is to insure against possible liability or loss and or to compensate for financial losses that have already been incurred. And that's what the insurer is doing. The insurer is indemnifying the insured against whatever that policy is designed to cover up into whatever the limits of the policy might be. And it's important to consider, we'll talk about this later on in this presentation, but it's important to consider what the policy limits are, because if you buy insurance but the limits aren't consistent with what you need, you could end up with a product that doesn't really solve your problem. In addition to providing you with this insurance product, the insurer has to do something else. And this one we don't hear a lot about in the news or elsewhere, but it's a really, really important benefit. And that is the insurer must provide a defense for the insured. In other words, the insurer has to represent the insured in court. Let's say there's a lawsuit about whatever the matter is. Well, the reality is hiring an attorney and getting that representation is oftentimes as expensive as paying out the claim. This is a really, really cool protection. It means that you're going to have somebody who's going to be representing your interests and the insurer's interests, and you aren't going to have to pay any more for that if you're the insured. So an important advantage to insurance. Let's consider the idea of a claim. A claim is what the insured files when something has gone astray or wrong in his or her life, and that person wants to file a claim with the insurer saying, hey, you need to pay me money because what I was insuring myself about has finally happened. And it can be a claim for money, property, or repairs to property. So a claim, if it's life insurance, a claim would be, hey, I guess the beneficiary would be making this claim, hey, the insured has passed away. You need to pay out the life insurance proceeds. Or if it's a health insurance situation, hey, I broke my arm. Here are the medical bills. You need to settle them. Or if it's a property casualty situation, hey, I had flood insurance, my house got flooded, here are the costs, the bills that I've had to incur to repair my house. Those are the types of things we're thinking about when we talk about claims. So that's kind of an introduction to some vocabulary relating to insurance and some ways to think about insurance. Let's now drill down and talk a little bit more about the types of insurance. We've already talked a little bit about property and casualty, but let's also consider a few other types, and we'll drill down on each one of these in a little bit more detail. One is liability insurance. Another is employee liability insurance. We're not going to talk about dram shop insurance except to say that it is not required in Texas. This is a particular protection that some states require alcohol license businesses to have. And what it does is it gives that entity insurance coverage in the event that somebody leaves their bar or restaurant in an intoxicated state and maybe is in a car accident and harms somebody else. And so when that other person sues the restaurant where the person became intoxicated, then the dram shop coverage kicks in. The business files a claim against the insurer has to provide a defense and settle any claims that might need to be settled under those circumstances. So it's a really smart type of insurance to have if you are especially a bar, but also some restaurants. But unlike those other states, in Texas it isn't a required part of the licensing process, but it's still probably a good idea, especially if you can get it at a reasonable price. Another type of coverage is the health, dental, and vision type package. Maybe it has all three components, maybe it just has one or two. And then we'll also talk about workers' compensation coverage and how that works, and more specifically, how that works in Texas. Obviously, the particular insurance that your business has is going to turn on where it is geographically located and also what the nature of the business is. If you happen to be IHOP, you probably aren't worried too much about dram shop protection because you probably don't sell anything that's alcoholic. If you aren't near any water, you're inland, you perhaps aren't worried about flood insurance or hurricane insurance. So some particular concerns would apply in certain parts of the country, might not apply in other parts, or might apply to certain businesses and not other businesses. So we're going to drill down and talk about, we've already kind of talked about property casualty, so we're going to now talk about liability type coverage. Here we go. Okay, so we're going to look at this as kind of three subcategories. One is coverage that will kick in when your business damages the property of another person. So this is not damage to the property that you own, but damage to someone else's property. So this might kick in if your guest, let's say there's a fire in your facility and your guest property is damaged because it's been in the building where the fire is. Another possibility is personal injury liability coverage. Imagine that one of those guests wasn't able to escape from the building and was burned as a result of being in the fire. You'd want to have this kind of coverage. And finally, we have advertising injury liability coverage. This would be when there's a claim filed because of some kind of false advertising associated with the business. So we have talked about property and casualty. We've talked about liability. By the way, employee liability is a subcategory. This is when your employee, instead of maybe Mother Nature putting things into the mix, your employee has taken some action that has caused there to be some liability. It could be sexual harassment, it could be theft, it could be some kind of assault or something along those lines. Let's now talk about health and then the health, dental, and vision type category. And then finally, we'll talk about workers' compensation. Okay, so let's talk about health insurance. So the first thing to think about when we're talking about health insurance is, why do businesses elect to provide health insurance to their employees? There's lots of historical reasons that we have established health insurance through our employers. It's somewhat of an unusual model in the Western world. Most large first world countries provide this through some kind of governmental entity in that. While we certainly do have some products like that, Medicaid, Medicare, for example, most people who are employed, or at least a large portion of people who are employed, get their health insurance not through the government, unless of course they're employed by the government, but through their employer. And as again, there's this historical reasons, but the most important reason today, I suppose, is that there are significant tax breaks for those businesses to provide those types of coverages. We call this law ERISA, and it is a tax law. Let me just type this up here so we can see if I can get a cursor. Here, ERISA. Now, ERISA doesn't require that employers carry health insurance, but just gives some pretty strong incentives. So if you think about the fact that most businesses want to recruit and attract desirable employees who would be desired by other employers, for example, and if you assume that businesses also want to retain those highly qualified employees, you can see why they would want to offer health insurance. When you add to that there are these tax benefits, most large employers provide pretty good health insurance. Some smaller businesses perhaps don't, but again, as you get larger and larger, that's one of the upgrades that typically larger employers do. There also are some legal requirements. A recent law is the Affordable Care Act, or ACA. It's also commonly referred to as Obamacare. This is a law that requires larger employers to provide health insurance, and if they elect not to provide the health insurance, they face a penalty payment. So think about it. Those larger employers want to attract and keep the best employees. They know if they provide those health insurance, they're going to be able to take advantage of ERISA, and they certainly want to avoid paying a penalty. So for those reasons, larger employers typically do elect to have the health insurance, but they aren't required to. They can elect to take the penalty instead. This is obviously an evolving area of the law. We aren't sure what ACA or the next generation of ACA will look like. This is kind of a moving target. Let's talk a little bit about COBRA. This is another statute, the Consolidated Omnibus Budget Reconciliation Act, I think is what it stands for. The name doesn't really make a lot of sense in this context, so you don't need to know the name of the law, but let's talk about what it provides. Well, first of all, just like ERISA and the Affordable Health Care Act, COBRA is a federal law, so it's going to apply in all 50 states. This law requires, and by the way, COBRA came long before ACA, so COBRA is less essential, honestly, today, now that we have the Affordable Care Act, than COBRA. It's less central, I guess, to the mechanism that we have to ensure coverage today than it was pre-ACA. But let me tell you how COBRA works. Imagine, and this actually is kind of a personal story of mine, but I think this applies to most people. I had insurance through my employer, and I chose to leave employer A to go to work for employer B. When I went to work for employer B, there was a waiting period through employer B's insurance before I could actually sign up. I think it was 3 months. Well, I did not want to have a gap in coverage during those 3 months. What if I was diagnosed with a bad illness, or what if I was in a car accident? That was too risky. But without COBRA, I wouldn't have had really good options for that period of gap, which was, again, inevitable because I couldn't work for both companies at the same time, and yet I was not eligible to get the insurance from my second employer until I was there for 3 months. So the only way I could get insurance would be by maintaining my first insurance through my first employer, or I guess I could have bought something off of some kind of other market. But insurance through those types of markets, especially a policy for, say, 3 months, would be very expensive. and probably very incomplete in terms of coverage. At least it would have been back in this time period before ACA. So what I did was what most people do, and that is I continued my coverage through my first employer using the benefits of COBRA. The positives about it is that it allows me to continue my insurance for 18 months after I leave my place of employment. And I can leave for any reason. I can be laid off, I can be fired, I can even resign, which is what happened in my case. It doesn't really matter the reason that I separated in 99% of the cases. Anyway, I can continue those benefits for up to 18 months. That's the good news. The bad news is I pay not just the active rate insurance, but the entire insurance that both I have been paying and my employer has been paying. Typically, employers pay about 2/3 to 3/4 of the premium. So let's imagine that I am paying, we'll say, $250 a month. Well, it could well be that my employer was paying $750 a month for my same coverage. That was its portion. So the total insurance that was being paid for my insurance each month was $1,000. So I would then go from paying $250 a month to paying $1,000 a month. But not just $1,000 a month, I'd have to pay also that 2% administrative cost. So we would have to add, I guess, $20. So I would end up paying on a monthly basis $1,020 to the insurance company every month. Well, especially during a period of career transition, a lot of people don't have the kind of extra money that this requires. So that's one of the challenges with COBRA, especially if you've been laid off or involuntarily separated. You may well not have the money available to you to take advantage of the COBRA benefits. And the COBRA benefits, again, don't go on forever. It's 18 months. In some cases, it's 36 months, but that's kind of beyond the information level we need to cover in this class. So what did ACA do or is doing? Well, it requires employers to have some healthcare products available if it's a larger employer. Obviously, it has other components to it that allows people to buy health insurance in the market system as well. So that's kind of beyond the scope of this course to talk in more detail, but hopefully this has kind of introduced you to some of the healthcare issues. Let's now talk about workers' comp. Workers' compensation has to do with workplace injuries. It's not about paying workers appropriately or any kind of severance issue or anything like that. It's simply about providing workers with health insurance if they are injured, and also to pay them lump sums if they have some kind of long-term injury, such as they have a finger amputated or they die. There's a lump sum payment for those body parts that might be impacted. In order for a workers' compensation claim to be effective, the worker had to have been working within the course and scope of his or her duties at the time of the injury. And what does course and scope mean, by the way? This is a term of art. You'll see this all over the place in employment law. And that is all of the stuff that that particular employee does that he was directed to do by the employer or that he or she was permitted to do by the employer. So let's imagine for a second that I am a Target cashier. So when I'm behind the cash register, wanding and bagging and accepting money from customers, I'm clearly acting within the course and scope of my duty. Let's say that I do that 90% of the time that I'm at Target, but some of the time I spend stocking shelves. Well, again, that would also be within the course and scope of my responsibilities. Maybe occasionally I am in the back watching training videos. That would be another thing that I'm doing within the course and scope of my duties. Let's say my supervisor is a little bit slack, and so sometimes I kind of hang around talking with my buddies when we're between customers, when there's a slow period of time. It's not that I'm doing anything secretive, I'm not hiding or anything, but my supervisor doesn't usually fuss at me if there aren't customers that need support. Well, guess what? When I'm on the clock doing that, it's probably also within the course and scope of my duties. One thing the textbook gets wrong, which is kind of surprising because our textbook author is based in Houston, so he ought to know better than this, but he says that all 50 states require employers to have workers' compensation insurance. And that's true pretty much everywhere but Texas. Oklahoma is a little bit different too, but not as different as Texas in this area. So if you go anywhere else in your professional life, you will likely find that your employer will be required to have a workers' compensation coverage. But Texas doesn't require private employers to carry it. Certainly in Texas, and private employers can carry it, and many do. But the employer also has the option of going bare or non-subscribing. And there's a variety of different ways of doing this. Now, you may be thinking to yourself, well, gosh, that doesn't sound like a very good deal for employees. It's a more complicated question that presents because when an employer has workers' compensation coverage, that type of insurance product, the worker is going to get certain benefits. The good news is that the worker doesn't have to prove some things that he ordinarily would in the court of law, so that's the good part. But the bad part is he isn't going to get all of the benefits that he ordinarily would in a court of law. The employer gets to choose, are we going to allow the employee to sue the employer? There won't be nearly as many caps, so there's a greater risk that there will be a large payout for that employee. But it's more difficult for the employee to navigate through the system, and the employer gets to advance certain legal defenses that he ordinarily would not be able to advance in a workers' compensation scenario. So there's pros and cons for both the employer and the employee, but definitely a trend in Texas is for employers to forego workers' compensation coverage. Now, Texas employers have the option of getting different types of insurance that might not be workers' compensation insurance. When an employer decides to go bare, to not have workers' compensation insurance, they have to post a notice in the workplace about that. Okay, so we've talked generally about insurance products, and we've talked about the types of coverage. Now we're going to talk about selecting an insurance carrier. What insurer are you going to use? The term that we use for this is underwriter. And what does an underwriter do? Well, it assumes the maximum levels of liability in the event of a loss or event of the damages. So, of course, that's the insurance company. It is the underwriter. Now, very likely you deal with an insurance agent. Sometimes an insurance agent only handles products for a particular insurance company. For example, your Allstate insurance agent or your Farmers insurance agent. Some insurance agents are independent. They handle a variety of different insurance companies. The idea here is that when you go to see Bob, the independent insurance agent, he can show you products that maybe State Farm or Liberty Mutual or lots of different companies might have. And so the idea at least is that he's a little bit more independent. He can compare products. If you go to an Allstate agent, the only products you're going to see are, Allstate products, that's what you want, then that's a good place to be. One of the concerns that you ought to have is not so much about the financial position of your insurance agent. He or she really, his or her financial well-being isn't really relevant to you. What you're concerned about is your insurance company economically stable, financially stable? Because what if there's a claim? You don't want it to be belly up after you've put in all of that money through premiums. So you want to make sure that your insurance company is on rock solid footing. Depending upon the rating agency, the rating that you might be looking for could be an A1, or an equivalent rating is a AAA rating. Those indicate that your insurance company is in very, very strong, good health. So let's just check this out. Let's see how we go about checking this. And this is a good idea for you to do as a consumer. So I'm going to go over here to our insurance. So what we do is we go to insure.com. And we check under additional resources. And our first button is financial strength rating. So we're going to click on that. We can see here we can actually get the financial strength ratings in this middle section. I'm going to go down here to the bottom where it has this little section that's in blue. What do the ratings mean? This is going to tell you about Standard & Poor ratings. And here we have, this is that AAA we were looking at before, right? So AAA is an insurer rated AAA. It has extremely strong financial security characteristics. AAA is the highest insurer financial rating, strength rating assigned by Standard & Poor's. Let's look at the other extreme. We'll look at CC. This is an insurer rated CC, has extremely weak financial security characteristics and is likely not to meet some of its financial obligation commitments. So obviously you want to be over here, AAA, not over here at CC. So let's just go through and test something out. I'm just going to type in Allstate, just to kind of see what Allstate is like. And of course, we're going to see lots of different entities. Allstate's going to have lots of different companies associated with it. Let's see if we can scroll down and find one that's based in Texas. So we're going to do Allstate Texas Lloyd's, and this is AA negative, so that's not as good as AAA. And in fact, as we're looking at this listing, we're not seeing any AAAs with Allstate. Let's do State Farm. State Farm has a lot of AAs. Let's look at Liberty Mutual. Okay, they have some A's and one that is BBB, not quite as good. Let's see if we can look at the extremely strong. Huh. So I guess they don't have any AAAs these days. Okay, so it looks like AA is our best bet. What I was saying before about AAA being where you want to be, looks like those aren't available. So we can see here that we do have some AAs. ACE is one. You can see Aetna also has some really good ratings. These are going to be alphabetically arranged. We see some Allstate with good ratings. We can see American Income, American Guarantee, American Zurich. Those might be ones worthy of consideration. Okay, so that just kind of gives you a flavor of what to consider. You can see there's a lot more we could look at, but we're not going to dive too deeply into that. Okay, so now we're going to talk about selecting that insurance policy. Let's say we've decided on one or more carriers that we want to get quotes from, but we have to know what are the characteristics we want our insurance policy to have so we can get a good quote on it. Well, there's lots of different factors that consider, and it's important when you're comparing insurance products to compare apples with apples and oranges with oranges. You can't just say, well, that's $1 million policy and price it against another $1 million policy. There's too many factors to capture with one number. So let's consider, first of all, the primary coverage that we're considering. And of course, within this topic, we're going to consider the limits and the coverage of that policy. There was a time, for example, in the 1980s, I suppose, when the AIDS epidemic was so concerning that some insurance companies excluded AIDS and AIDS-related conditions and HIV from coverage. And so as a result, a person could buy insurance, but they weren't necessarily going to be protected against that particular illness. Well, if that's the illness you got, you probably were pretty disappointed. You paid in and yet you're not getting a coverage. So you want to make sure that the coverage that you're seeking is actually going to protect you against the things you're concerned about. And so that's something to consider. Not all policies are created equal. Perhaps it's important to you that the policy cover X, Y, and Z. You want to make sure that X, Y, and Z are covered. In addition, you want to also consider what the limits of the particular coverage is. There very possibly is going to be a per occurrence limit, And there's also possibly going to be an aggregate amount limit, and we'll talk more about those in a second. So this is a second characteristic and a third characteristic you need to be concerned about. Let me go ahead and flag this. So we're concerned about the limits and the coverage components. We're concerned about the per occurrence limit, and we're concerned about the aggregate limit. We're also concerned about the deductible. What kind of deductible are you looking at? So we have these characteristics you'd be concerned about on the primary coverage. You may also be considering an umbrella policy. This is a policy that provides coverage above and beyond the primary coverage, and you'd have these same issues with respect to that umbrella policy. So you have to have a little bit more specifics in order to decide whether you're looking at apples or oranges. Okay, so we're going to first of all consider in a little bit more detail what we mean by the primary policy. Let's look at this in more detail. Okay, what is it? It's the main insurance that provides the basic coverages and the amount, and it obviously would include the amount of insurance that you're being provided under the policy. Sometimes the primary policy is called the basic coverage. It's what you're going to go to first as the insured. This is your first line of defense against whatever the event is that's happened. Now we're going to look at those other factors, the per occurrence amount and then also the aggregate amount. What do those mean? Let's go see. So per occurrence is the maximum amount that can or will be paid by the insurer in the event of a single claim. So imagine that you have property casualty insurance and each occurrence is limited to $100,000. A hurricane, well, let's not use a hurricane. There's a fire. There's an electrical short in your building and the building burns down. It's a total loss, but your per occurrence is limited to $100,000. The stuff that burned up was worth $400,000. So you only have insurance for $100,000. You're out $300,000 on top of that. Obviously, you probably had a lower per occurrence than you ought to under those circumstances. That's how per occurrence works. Now let's say you rebuild that same year and you unfortunately have another fire. Well, guess what? You would have to again have that coverage up to $100,000. So this might, hopefully you won't have multiple events, but if you do, you would be back to having coverage for each one of those events. Unless you exceed your aggregate. And this is the maximum amount that can or will be paid by an insurer for all claims during a policy period. So as you have the first occurrence and the second occurrence and the third occurrence, you're adding all of these amounts together until it reaches your aggregate. And then your per occurrence turns off. If you have another fire, you don't have any insurance, even though your per occurrence is for $100,000. Once your aggregate is satisfied, no more coverage. And again, typically an insurance policy is going to be for a year, so it will be for the remainder of that year once you've met your aggregate that you cease to have insurance coverage. Let's now consider the umbrella policy. And an umbrella policy, again, is the idea that this supplements your primary coverage. It's like that umbrella, you know, which covers more than just you, but the kind of area around you. That's the notion behind an umbrella coverage. Many times this is called excess insurance, kind of like primary insurance is called basic insurance. Whether you are buying umbrella insurance or primary insurance, you've got the issue of deductibles. And this is the amount of money that the insured has to pay before the insurance coverage actually kicks in. So going back to our example of having a per occurrence coverage of $100,000, well, there likely is a deductible before we get to that. Maybe the first $10,000 the hotel is on the hook for. So the deductible is $10,000, and then the insurance pays the next $100,000, and any amount after that, the business again is on the hook for. You can see the higher that the deductible is, the cheaper the insurance is going to be. because most events that happen are relatively inexpensive. Most of the time, the whole building doesn't burn to the ground. There's just some wind damage or there's just some smoke damage. And oftentimes, the amount of the damage might actually be less than the deductible. And under those circumstances, the insured doesn't ever have a claim to file because the insured just goes ahead and pays it because it's actually less than his or her deductible. So you can see the higher the deductible that exists in the policy, the less risk that the insurance company has, and therefore the lower the premiums would be. So a very risk-averse business might have a lower deductible, especially if it doesn't have a lot of money to pay for deductibles. But if it's a pretty solidly financed business, it can probably afford to pay out a few deductibles to pay for the damage that has been sustained by the business. And that might be a way for it to lower its premiums by having a higher deductible. And that can be a smart strategy. Let's consider a scenario this is designed to show some of the problems that can arise when a business isn't savvy about how insurance products work. So let's consider this particular business and the insurance products it has purchased. So the business purchases a primary policy with a $500,000 per occurrence limit and a $500 aggregate coverage. So in this situation, let's assume, let's just first of all see how this works. So let's imagine the first occurrence, let's say there are no deductibles, we'll keep it easy. The first occurrence, there's damage of $50,000, okay? So that's well within the $500,000 per occurrence. And now the aggregate is down to $450,000 because we'll subtract out that $50,000. Well, there's another claim, and this next claim is for $100,000. Again, well below the per occurrence $500,000 level. So the per occurrence is still okay, and it's still below the $450,000. So now we're going to subtract for this occurrence $100,000. So now we're at $350,000 for our aggregate remaining coverage. And this number will continue to go down as we have more and more incidents. So hopefully that helps you get the difference between per occurrence coverage and aggregate coverage. In this scenario, though, this business doesn't just have a primary policy, it also has one of those umbrella policies. And this one has $1 million in coverage. Okay, so let's imagine how this might play out. The business actually experiences a $750 claim. Well, of course, the primary insurance company pays out its per occurrence amount of $500,000. And then, of course, the business it now is in the excess insurance category, so it turns to its umbrella policy and says, hey, umbrella policy, you need to pay the difference between the $500,000 and the $750,000. So you need to pay $250,000, which is well within this coverage here. And that's what the umbrella insurance does pay. So in this particular case, the business gets the entire claim paid by combining the two insurance products. $500,000 from the primary, $250,000 from the umbrella policy. Unfortunately for this business, the primary policy is now done because not only was the per occurrence amount satisfied, the aggregate was also satisfied. So the primary insurance is done for that year. There's no more to be paid. No matter what happens, the insurance is no longer operative. Okay, later that year, the business has another loss. This time it's only $600,000. The business knows it can't turn to its primary policy because it knows it's kind of completed that issue, so it goes to the umbrella policy. Well, it's very disappointed to learn that umbrella policy only works when you have primary policy because it's designed to fill in the gaps of the primary policy. Because the primary insurer doesn't have any obligations, because after all, the aggregate was satisfied, the umbrella insurance company is also done. And so there isn't any more coverage beyond the $750,000. So you can see how you have to really game it out and think about the variety of scenarios to make sure you're buying the product that's really going to be meaningful for your business model. Okay, so we've talked about, again, insurance overall. We've talked about the different types of insurance. We've talked about how to select an insurance carrier. And we've also talked about selecting the insurance policy that would be the best fit for your business. oops, here we go. We're going to talk a little bit about how to look and to analyze the policy that you have received here. An important document when you are comparing policy options, when you're deciding between policy A and policy B, is to look at the face sheet. It's a one-page document that explains the type of coverage that is being offered and the details of that coverage. This is actually produced before the policy itself is written. It takes a little while for the policy to actually be written. Many times the business has already accepted the policy before the ink is dry, the I's are dotted, the T's are crossed. And so the decision about which policy to take may well turn on what the face sheet says. Another term for this document, by the way, is declaration page. When you are considering policies, you also have to consider the exclusions that might exist. These would be circumstances that the insurance company would say, yeah, ordinarily this type of claim is the type of claim we would pay on, but we're not going to pay on this particular claim because something about this claim is not covered by this insurance policy. Examples of these types of exclusions are intentional acts. So let's say that an employee intentionally, let's say Bob is the Target cashier and he's having just a bad day, and so Grandma comes up to check out her groceries and Bob just punches Grandma in the nose. It's not an accident. He intentionally hit the elderly lady in the face with his fist. She naturally sues. Target says, well, we want to file a claim, an insurance claim against this particular incident. We want the insurance company to pay out the claim. But the insurance company might say, depending upon the terms of the contract, well, that wasn't an accident. Bob completely meant to punch Grandma in the face. Because it's an intentional act, generally speaking, you can't buy insurance against intentional acts because there's what's called moral hazard. There's the risk that I will intentionally do the act simply so I can get the payout. Another exclusion is if the insured is committing fraud. Let's say that Target is in cahoots with Grandma, and maybe Bob never punched Grandma in the face at all. Maybe Target and Grandma intend to split the proceeds from the policy. Obviously, the insurance company isn't going to pay under those circumstances. So those are just two examples of the types of exclusions that might apply. There's also things called exceptions. An exception has to do with it's not so much relating to the particular type of claim that is being made, but how that claim has been processed. And a common problem with that is when the insured waits too long to file the claim. The insurer has the expectation to be immediately informed about the claim as soon as the insured becomes aware of the claim. That allows the insured to be in the best position to research the claim and to defend itself and the insured against the claim. With the passage of time, defenses and other opportunities may be foreclosed by the insurer, and so the law recognizes that this is a reasonable expectation. So the insurer should promptly let the insurer know under those circumstances. If there's delay, that may mean that the insured is going to be financially responsible for the whole claim, even though the insured had insurance that ordinarily would cover it. So now we've covered all 5 of the topics in this chapter. We've discussed insurance generally, the types of coverage that are available for businesses. We've discussed how to select an insurance carrier and the policy that you might want to have. And we've talked about issues relating to how to analyze an insurance policy product. I hope that this has been helpful. As always, please feel free to email me with any questions that you might have about the material. Alternatively, I would certainly welcome a visit from you so we could discuss any questions or concerns that you have about the material during my office hours. I hope that this information has been helpful for you, and I hope that you have a great day. Thanks so much for watching.